Welcome to the Nadex Application and Strategy Webinar Series presented by Daryl Martin from ApexInvesting.com. Today we're going to talk about the futures E-mini Dow futures contract specs. We're going to go into the Nadex Spread Wall Street 30 contract specs and basics, the Nadex Binary Wall Street 30 contract specs and basics, and put them all together for you, showing you the advantages and disadvantages of the futures versus the spreads and the binaries. The Nadex Wall Street 30 spreads and Nadex Wall Street 30 binaries are derivatives of the CME E-mini Dow Index Futures, symbol YM. A derivative is simply an instrument where the price is derived from something else, like a mortgage is derived from a house. It is helpful to understand the basics of the underlying instrument that the product is derived from when trading a derivative. The product name for the CME E-mini Dow Index Futures on Nadex is the Wall Street 30. The E in E-mini means electronic, means it's only traded electronically, and the mini for smaller than the full-size contract. The Dow futures are quoted in dollars, and that's the actual quote of the E-mini Dow futures. Well, the value is $5 per dollar quoted. So the contract's values would actually be something like $67,500 if the Dow is currently quoting at $13,500 times $5. So the tick size and the value of that tick, again, the tick size is 1 because it moves in at dollars, and 1 point is worth $5. So every time it moves up or down a tick or a point, that is a value of $5 on the Dow. Now, one thing that's really important that you do understand when trading futures, and you need to understand limit moves. If overnight there is a 5% up or down move from the previous day's settlement price, then the market will be closed till 9:30. If after the market's open and there's a 10% limit down move from the previous day's settlement price, then it'll be closed for 10 minutes, 20% move, another 10 minutes, a 30% limit down move, then they'll actually halt it for the day. To find more information about that, simply go to the link on this page. Now, if you do buy a Dow futures contract and you hold it past the last trading date, then the position will be settled in cash as whatever the settlement price is as determined by the CME. Again, the future symbol on the CME is YM, and it's traded on the CME, which is the Chicago Mercantile Exchange, and it's only traded electronically on the Globex. For more details about the contract specs, feel free to visit the link below. The mini contracts are traded electronically between 5 and 4:15 p.m. Eastern Time, with a short break in between 4:15 and 5 o'clock of that same day. Now, the open outcry, the mini Dow is not traded on the floor, but the full-size contracts are traded from 9:30 a.m. to 4:15 p.m. Eastern Time. The future symbols months are H, M, U, and Z. H for March, M for June, U for September, and Z for December. And these are the months that the contract is traded. To get a contract symbol, you would combine the future symbol with the month with the year. So for the Dow futures contract for March of 2013, you'd have YMH3. When trading any futures contract, usually you want to be trading the most liquid month so you can get in and get out and not have too wide of a bid-ask spread. And the easiest way to figure out what the most liquid month is to simply look on the CME's website, and you can see the volume, and you'll easily be able to identify what the most liquid contract is out of the ones that have been traded that day so far. Now, like any futures contract, the margin is the amount you have to deposit in order to trade the position. To trade the E-mini Dow, the initial margin you have to put up is $27.50. That's the money that's held just to open a new long or short position. Now, the maintenance margin is $2,500, and that's the amount you have to put up to keep a position open. In addition, many brokers will offer day trading margins ranging anywhere from $400 to 25% of the initial margin, which would be $687.50, and the start times on day trading margin can vary by broker. One of the most important things you need to understand when trading futures is variation margin. In addition to the above margin requirements, the contract is marked to market, so profit and losses are added and deducted from your account balance as the market fluctuates. And margin requirements could actually change if there's a massive spike in volatility, and the exchange could require the broker to require you to immediately put up more money to keep that futures contract open. The combination of maintenance margin, leverage, and variation margin mark-to-market pricing can actually lead to you losing more than what is in your account. In many cases, this provides a lot of leverage, but at the same time, like I said, you could get a margin call. The contract you're trading is actually worth $67,500 if it was quoting at 13,500 times 5. $5 per point or tick. With only $400, that gives you a 168 to 1 leverage. And a margin call again can occur when your balance drops below the margin requirement and the position is shut down, or if there wasn't time, a demand for an additional deposit is made by the clearinghouse. The CME's YM or E-mini Dow index future contract is a derivative whose price is derived from the Dow Jones 30. The E-mini Dow Jones 30 is derived from the 30 stocks in the Dow Jones Industrial Average list. And the stock shares themselves of the 30 different stocks are derived from the company's underlying value. Well, the Nadex Wall Street 30 spreads are also a derivative, and they are priced where their pricing is derived from something else, such as the E-mini Dow futures. The month contract that the Nadex spread is derived from, or the Nadex binary is derived from, is listed in the contract's name in order to help avoid confusion. And to know the proper month to look at the correct chart of the underlying market when you're trading the spreads of the binaries, simply look at the month noted next to the index future contract, such as in this instance, it shows March. So you'd look at the March E-mini Dow futures contract. The Nadex Wall Street 30 spreads price is not derived from the Dow Jones Index, and it's not derived from the Diamond ETFs. It is derived from the CME YM E-mini Dow futures. So it's really important that when you're analyzing a chart, you're looking at the correct underlying instruments chart. Nadex's Wall Street 30 spreads allow you to trade the E-mini Dow with a contract that trades similar to the underlying with less money, limited risk, as your risk never increases as your margin is your maximum risk. You have no fear of being stopped out by a market spike, and you have until expiration of the spread to be correct about price movement and direction. In addition, you have no fear of a margin call, since your risk is capped, as all trades risk is fully collateralized, so you'll never receive a margin call, and therefore you'll never lose more than what's in your account. And you have no fear of having to make or take delivery of a stock, like with a call or put option on the diamond. The Wall Street 30 Nadex spread ticks in 1. Every tick on the Nadex spread, on every Nadex spread, is always worth $1. So each 1 point move is equal to $1. Well, since the YM contract ticks in 1 and has a tick value of $5 for the futures contract, it takes 5 Nadex Wall Street 30 spreads to have a 1 point fluctuation in a Wall Street 30 spread to be equal to the same value as a 1 point or tick fluctuation in the Dow futures contract, such as 1 tick times $1 per tick times 5 Nadex Wall Street 30 spread contracts would equal $5 per tick, or you could call it point. So now let's look at an example of a Nadex spread, and let's look at how much you'd be risking if you bought the spread. So if you bought the spread, what we'd do is we would take the bought price, the offer price at $13,929, and we'd subtract it from the floor. The difference is 29 ticks times $1 per tick is $29 times 1 contract would equal $29 risk. Since the risk is $29, the margin is only $29, and the risk will never increase beyond $29 no matter how far the market moves against you, and you have until expiration to close the trade. Well, now let's look at the profit potential if we bought the Nadex spread. And to find the profit potential, we simply look at the ceiling, and we subtract that from the price we buy it at. So the ceiling of $14,300 minus $13,929, the offer price, equals $371. So because that's 371 points times $1 per tick equals $371 a contract. If we do 1 contract, we have a $371 profit potential on a $29 risk. And it's important to remember that you can close the spread at any time between opening and expiration. And if you hold it to expiration, it will automatically settle, and the difference between where you bought and the expiration settlement price will result in your net profit and loss. So what if you thought the Dow was going to go down? Well, then you could sell the lower spread. So let's say we went in, we sold the spread, and to figure out our risk on it, what we'd do is we'd look at the ceiling of 13,900 because we can't lose any money above it, and we subtract that from our sold price of 13,869, and that'd give us 31 ticks. At $1 per tick is $31. With one contract is $31 risk. Since the risk is $31, the margin is also only $31. And the risk will not increase beyond $31 no matter how far the market moves against you, and you'll have it until expiration to be able to close the trade. So to calculate the profit potential, we simply take the sold price, 13,869, minus the floor, because we can make money all the way down to the floor of 13,500. Well, the difference between those two is 369, and we make $1 per tick, or up to $1 per tick. So on that, that's $369 per contract profit potential, giving you a profit potential of $369 on a $31 risk. Now, you may choose to close the spread anytime between opening and expiration, and if you hold its expiration, it will automatically settle, and the difference between where you sold and the expiration settlement price will result in your net profit or loss. And again, you could close it at any time with the profit being or loss being the difference between where you bought and where you sold. Profit not being greater than all the way down to the floor, and the loss not being greater than up to the ceiling. The Nadex Wall Street 30 spreads have multiple times that you can trade them. They have intraday 2-hour spreads that start at 8, and then there's another one at 9, 10, 11, 12, 1, and 2. You also can do the 8-hour and 15-minute spreads, and all the spreads, as you notice, have 3 strikes that are less than the master spread, and they are 300 points wide on the 8.25. You'll notice on the dailies, they're 400 points wide. So the longer that they trade, the wider the spread is. And again, what they do is they take the spread amount, 400 pips, and they put it 400 pips above where the market's at, 400 pips below where the market's at, and 400 pips straddling where the market's at. There's also a master spread that is 800 points wide. The Nadex Wall Street 30 binaries are another trading instrument available at Nadex that allow you to trade the movement of the Dow futures. And they're a contract that can be used in both flat and volatile markets. You can use less money to trade them. You have a limited risk, as your risk will never increase, as your margin is your maximum risk. You have no fear of being stopped out by a market spike, and you have until expiration of the binary to be correct about price movement and direction. In addition, you have no fear of a margin call. Since your risk is capped, as all your trades' risk is fully collateralized, you will never receive a margin call, and therefore you'll never lose more than what's in your account. You also have no fear of having to make or take delivery of a commodity, stock, or future contract. The Nadex binaries in their most basic form are a true or false statement. So if you buy it, you're saying that the statement is true, such as the Wall Street 30 Dow Futures March contract will be greater than 13,985 at 4:15 p.m. Eastern Time. If you sell it, you're saying that statement is false. So you're saying the Wall Street 30 Dow March contract will be less than or equal to 13,985 at 4:15 p.m. Eastern Time. Again, less than or equal to, because you're saying the statement is false when you sell. Now, a huge tip is that you can close the binaries, just like the spreads, at any time before expiration. So the statement does not have to be true or false at expiration for you to potentially profit on the trade. All Nadex binaries have a maximum value of $100 and a minimum value of 0. If the binary is held to expiration, it'll be worth either 0 or 100. It must be in the money to be profitable. In the money on a buy means the Nadex settlement price for the Dow futures is greater than the strike at expiration. In the money on a sell means the Nadex settlement price for the Dow futures is less than or equal to the strike price at expiration. So if we bought the binary that says that the Dow futures March contract will be greater than 13,985 at 4:15 p.m. Eastern Time, we're saying the statement is true. Well, the offer is $15.50. Well, when we're buying, the offer side shows our risk. So the risk is $15.50. And the profit potential is $100 minus that risk, because the profit potential is $84.50 for each contract we trade. And again, you could trade one, or you could trade 100 or more. The margin to the trade is the maximum risk, which is $15.50. Now, if we think the Dow is going to go down, we could sell a binary, and we could sell, say, the Wall Street 30 March contract greater than 13,825 at 4:15 p.m. Eastern Time. If we sell, we're saying the statement is false, that it will not be greater than 13,825. When we're selling, the bid column actually shows us our profit potential. Remember, when we're buying, the offer column shows us our risk, but when we're selling, the bid column shows our profit potential. So since the quote is 85, that means we could make $85 on the trade, and our risk would be $100 minus the quote of 85, or $15. Therefore, the margin to do the trade would be $15. Nadex Wall Street 30 binaries have a large number of contracts, strike widths, and trading hours you can take advantage of. And on the intraday binaries, they are 20 points wide. There's 9 strikes, and they start at 8 and start another one at 9, 10, 11, 12, 1, and 2. There's 21 strikes on the dailies that are 20 points wide, Monday to Friday, 8 a.m. to 4:15 p.m. Eastern Time. And weekly, there are 13 strikes that are 100 points wide, and they start at 3 a.m. and go to 5 p.m. on Monday, then 6 to 5 p.m. Monday through Thursday, and 6 p.m. to 4:15 p.m. on Thursday to Friday. Nadex Wall Street 30 spreads and binaries allow you to trade the E-mini Dow futures price movement with less money, with limited risk, as your risk never increases, as your margin is your maximum risk. You have no fear of being stopped out by a market spike because you have until expiration of the spread to be correct about price movement and direction, and you have no fear of a margin call since your risk is capped, as all your trade's risk is fully collateralized. Therefore, you'll never receive a margin call, and you'll never lose more than what's in your account. Plus, you have no fear of having to make or take delivery of a commodity or a stock or anything of that sort. To open a live and or demo account, simply go to nadex.com today. Also, visit us today over at apexinvesting.com and learn more about how to trade on Nadex.